stop. Before you sell everything, watch this.
Controls the market right now. There's no doubt in my mind that you are confused about what's going on. We had a couple of weeks of total carnage. Then yesterday, one of the best days we have ever seen in the stock market. And that is confusing for everyone. Now, you're going to hear a lot of traders brag about how much money they've made yesterday, how much money they've made over the past few weeks. Traders love volatility, and that's okay. That's going to happen. But you got to remember that you are a long-term investor. Now, if you're a long-term investor and your time horizon is 5 to 10 years, you're looking at a market that basically is the same setup that we had just a couple of weeks ago. Nothing really changed. Now, we had a little bit of a discount over the past few weeks, and a lot of retail investors, they complain. When market flies up, they complain, oh, I wish we had a little bit of a discount. I wish for a dip. And when those discounts happen, people get too scared to buy them. And that's okay. I'm not mad and I'm not judging. I'm just saying that's the way it is. Now, I educate my community better than that, and we actually admire the dips, but 90% of retail investors, when the desired dip actually comes, they're too afraid to take advantage. That's pretty much what happened over the past few weeks. Now, a lot of people today are saying, well, Tom, I've missed it. Yesterday, the window of opportunity got closed. I wish I could have grabbed it. It's not true. You're going to have another opportunity and another opportunity, and there's going to be endless amounts of opportunities to buy the dip and get into the market. People thought they missed out in 2024. We're now back a year and a few months later to the same.
To this point, I agree with him completely. If you are a longer-term investor and you're looking to buy the dip, by all means, do it. But do it when stocks are crashing back up from the dip rather than crashing down through the dip. Okay, and we know where. So when the 10 crosses over the 20, price closes over the 50. And we can look at an example all the way back from COVID. I do this all the time because it's just math. It just works, right? Hold on. It's loading a little bit slow. Right. Rather than buying the dip on the way down, because we don't know how far it's going to go down. And if you remember at this time, the whole world was freaking out. And it went down 35% in the span of just a couple of weeks, 35%. And then if you had waited to get in when the 10 crossed over the 20, price crossed over the 50, this was your entry signal right here at 282, right? So let's say getting in at 282 on this side versus getting in at 282 on this side, you're already to profitability that much faster. You're already profitability that much faster. Not only are you to profitability that much faster, look how much less stress you had to worry about. How much less stress you had to worry about. Oh, sweet, we hit a bottom. Okay, things are cooling off. Things are coming back to normal. This is looking great. This is looking great. This is what I want to stress to you, is that you can totally buy the dip. Absolutely go buy the mess out of the dip. But just wait until the dip is on the other side with the 10-20 over the 50 versus on the current side, like we're seeing right now, where it's crashing down. It's a lot easier. It's so much easier.
Point we were in 2024. Nobody is in the rush. This is not a sprint. This is a marathon. Now, in this video, I'm going to share with you my entire strategy for 2025, how I'm going to bulletproof my portfolio. And obviously, it goes a little bit deeper than just dollar cost average. There's a lot of strategies, a lot of things you got to do to make sure your portfolio is bulletproof against this chaotic year, because the next 6 to 12 months, however you're going to spend it, are going to be absolutely chaos. So you got to be ready for this. You definitely don't want to miss today's video. So don't click nothing, don't smash nothing, don't buy nothing. Listen, first of all, obviously, a few words about the CPI data came out today, cooler than expected. A lot of people were.
That's great. Politics aside, I'm all about lower inflation.
Expecting the market to bounce because of this. Maybe it will happen, but you got to remember that the CPI data that we're getting right now, it basically happened before the tariff drama. So these numbers are basically pre-tariffs. And a lot of people are expecting that tariffs are going to push prices up, push inflation up. So that's why people are looking at these CPI data numbers with a little bit of a skepticism. Now, on the flip side, talking about the tariffs, I think there's a lot of misunderstanding about what's going on with the tariff drama in Trump. Now, this is not a political video. I'm not going to talk politics here. Not that I'm afraid to talk about my political stance, but it's not going to make you any money. So it's pointless. So let's talk about things that actually make you money. And what will make you money is understanding what's actually going on here. So I want you to put your opinions about Trump to the side, whether you're a fan or a hater. It doesn't matter. It's all about money today. So the tariff drama of Trump is not random. And I want you to understand this. There's a rationale here. Now, the rationale here is that the U.S. has a major trade deficit with a lot of countries, but mainly it's China. China is the prime example of a huge trade deficit. Basically, the U.S. buys a lot more goods than China buys from the U.S. And for decades, the United States basically ignored this problem and kicked the can down the road. And previous administrations basically didn't give a frick about this and never addressed the issues. And basically what happened is that over the past 35 years, the United States have absolutely annihilated and imploded and killed its own manufacturing base. And people kind of forget about it, that the U.S. actually used to make stuff. It wasn't always a service-based economy. And right now, the long-term strategic effects of losing the manufacturing base of America actually start to reveal themselves. And there's a lot of risk in this. The whole idea of America being the strongest, best economy in the world, it's kind of based on the idea that the US industry can be competitive globally. And now it's not because of China. China is basically dominating because of the cheap prices, because of the subsidies, and a lot of these things. And another major grievance here is that a lot of Chinese companies, because they own the manufacturing now, so they basically steal and knock off intellectual property, know-how, and that's not a huge secret, but all know this has been going on, but people have been ignoring this for years. Now, Trump's strategy is a little bit unconventional. I'll give you that, right? A lot of people would use a scalpel. They'll be more diplomatic, but Trump is an agent of chaos, and he's going to take a sledgehammer to any kind of problem, and this is one big sledgehammer. And he's, notorious for being very, very aggressive. Right now, the United States is saying to China, we're done playing nice. We have enjoyed you producing goods for us very, very cheaply, and that helped us boost the revenues and the margins of American companies. And because of that, we have put up with your BS for many, many decades. But now that is over. You have crossed the line. China has taken a very adversarial role against America, with Russia, with Iran. And essentially, the US administration is now saying, look, if you want to use us to grow your economy exponentially, and then you're going to backstab us, that's not going to fly. You have to realign with us. And that's the purpose of this. Not so much the economic stuff. Obviously, that's kind of a side effect, but it's more about where China is aligned on the global stage. The United States is basically saying to China, look, folks, we are your biggest market. If you don't sell to us, you can still sell to Russia and to the EU, but you're going to lose a huge chunk of your business, essentially rendering your whole economy useless. If we...
And, just to piggyback off that, I've made this point before, but I would bet you everything in my line of sight came from China. From the camera that I'm using, to the monitors I'm using, to my microphone, I know my phone came from China, to the Funko Pops of Scrooge McDuck I got sitting on my desk, to this pin that I use. I would bet you every single thing in my eyesight, including this DuckTales mug. It probably even says on here, made in China. Let's see. I don't want to spill it. Probably even says made in China. Produced under license, Silver Buffalo, New York, New York. Made in China. Yep. So, if we have crazy tariffs going on, I can't imagine how difficult this is going to be for most American consumers when everything in my eyesight right here was probably manufactured in China. That's going to super suck. That's going to like cripple inflation. It's going to be crazy. I don't want that.
Still buying, sure, we're going to get hurt. Sure, we're going to cry and it's going to be painful. We're going to increase inflation and our consumers are going to pay more. And maybe we even go into recession, maybe. But your economy, China, that thing is going to collapse because your entire economy is predicated on two things. Number one is that Ponzi scheme you got over there for the real estate market. That's 1/3 of the economy. But the other 2/3 are basically selling to the United States market. And if we block this market by imposing a 100% tariff, which is essentially like closing down that supply chain, well, we're going to suffer, but you're going to die. Essentially, they're playing hardball. This is Trump style. I'm not even surprised about that. And obviously, it's going to be like that scene from Breaking Bad when Gustavo poisons Don Eladio. So Don Eladio dies, but Gustavo takes a little pill and then he feels really, really bad, but he survives. That's the analogy I want to use here in case you've watched the show. So yes, the US will suffer. China will die. That's the whole point here. Now, until China finally gives in and actually signs a deal with America that actually favors the Trump administration just the way they like it, this standoff is going to continue. It's going to create a lot of pain, a lot of volatility, a lot of chaos. It's going to be unpleasant. But it's basically a game of chicken. Who's going to crack first? And trust me, the United States is not going to crack first because, unlike China, America can print money endlessly. Because you see, the United States is the world reserve currency. That's not going to change anytime soon, at least not in the next 50 years. And as long as that's the case, the US can just endlessly print money to pump the economy and keep it alive for as long as necessary until China, economically, of course, dies. Sure, it's going to raise inflation. Obviously, it's going to be unpleasant. All this is true, but the US only comes up on top here in every scenario. Whether China gives in fast or China gives in slow, it doesn't matter. The US wins this. And if you understand that, investing long-term in the US market is probably the smartest thing you can do if you have a long-term mindset. The lesson is that time in the market is a lot more important than timing the market. If you sold out, if you panic sold, well, you missed out on one of the greatest days in the history of the stock market. Emotional.
Okay. I do want to point this out because a lot of people made a big stink about yesterday, right? This nearly 10% up move yesterday. Nearly 10% up move yesterday. I honestly was looking for this earlier because this is one of those well-known things in the trader community that the largest rallies happen in bear markets. But of course, it is completely overwhelmed by the number of people talking about how this was such the giant rally in a bear market in the search results. And I didn't have time to go through all that. But giant rallies like this happen all the time in bear markets. We even looked at Now I wish I hadn't scrolled all the way over. But we looked at multiple examples in the past about how during the COVID crash, there was like a 9% rally, an 11% rally, giant double-digit rallies as stocks are crashing down. Does that mean it's a buying opportunity? Certainly not. Certainly not, because it is still in a bearish trend, right? One day does not make a trend, up or down. One day does not make a trend. Can it be the start of something new? For sure. But to say everything's back to normal with one single candle, I wouldn't bet. I wouldn't put my money on that. No way. No way.
Emotional control is 90% of investing. I keep talking about it, and people always ask me, Tom, why are you so repetitive about emotional control, about DCA, about all these things? Why you keep repeating this? Because my community, the people in my academy, patreon.com/Tom Nash, my community, my students, they haven't freaked out. They haven't panicked. We were celebrating for the past 2 weeks for all the discounts. And yesterday, we reaped the benefits. And maybe the stock market goes up 10,000 points. Maybe it drops 10,000 points. Who knows? We don't care what happens. We don't predict. We prepare. Now, look, Trump basically needs to open the Patreon at this point because Trump literally told us to start buying a couple of minutes before this thing was announced. If Trump sets up...
And okay, this feels real shady. This feels crazy shady to me. And this was a surprise looking at this. Like literally, I don't know how long it was before this was announced, but could you imagine he's in the back room, sitting on the toilet on his phone. He's like, I've got a huge idea. I have a tremendous idea. I have a monumental idea. Oh yes. Hey, Ivanka, shut the door. Let me get on my phone real quick. Okay. Now is a great time to buy. Signed, DJT. Yes, this is going to be huge. People are going to love this. I can't possibly get into any trouble. You guys know my politics, but good gravy. That feels so shady. Shady. Yeah. And then the market, rallies 10% in a single day. I don't know. I don't know.
It's up a Patreon with stock alerts and buy alerts. I'm going to sign up because this man knows exactly what's going on. He's not shy about sharing it. I think he needs to monetize this. Now, look, jokes aside, obviously you learned an important lesson. Whatever happens next, maybe we go down the escalator, maybe we drop off a cliff. I don't care. The best time to buy is in a bear market. Yesterday was a little example of that. Yesterday just shows you how quickly markets can rebound when sentiment changes and panic subsides. And of course, one of the main lessons from yesterday is that China is the story here. All other countries are basically just set pieces. It's all about China. I told you in the beginning. That's why the Chinese are not going to get off scotch-free from this. He's not going to back down. He's going to push China because China has no leverage. They have no cards in this game. Now, my question to all the analysts who have downgraded the S&P 500 over the past few weeks, are they going to upgrade it now that it's up? I mean, it's a bunch of BS noise. Now, you saw yesterday and you saw over the past few weeks why retail investors are always on the short end of the stick. Why these guys always get screwed. And yesterday was a prime example. If you see new or inexperienced investors, people who started investing over the past 6 months, 12 months, they make decisions based on immediate emotions a lot more than you guys, the more experienced people. They make decisions based on fear or greed. And I always explain, fear and greed are basically twin brothers. They're both evil. You shouldn't be buying like crazy because the stock is up. You shouldn't be selling like crazy because the stock is down.
I agree with that. I agree with that wholeheartedly. You should be following your plan. Following your plan is what's going to separate the best from the rest. And, I saw a lot of y'all on Discord talking about how much FOMO you had seeing that move yesterday, right? Do you still have that FOMO today when it's down 5% after a 10% up move? Probably not. But the point here is, if you had the plan to trade it when something like this happens, you got to do it. But if you didn't have the plan to trade it when something like this happens, why even stress on it? No more FOMO. No more FOMO. Don't be greedy. Don't be fearful. Just follow your plan.
A lot of these investors, they jump into the stock market and they come in a bull run and they get overconfident and they only see constant gains. And the first time they see some losses, panic sets in and they actually create the worst possible thing for themselves, selling at the bottom. And then they buy back again at the top. Once the market falls enough for these guys to start seeing actual red in their portfolio, which they've never seen before, all hell breaks loose. They start selling. They get emotionally anxious and panic and all that stuff. Now, look, I don't know what comes next. I don't know if we drop. I don't know if we go up. But right now, what you've seen the last couple of weeks, this is just a regular correction. Nothing dramatic has happened yet. If we see an actual crash like 2008 or 2000, you're going to feel it. What we've seen in the past 2 weeks, that's just turbulence. Now, look, a lot of people kind of misunderstand this buying the dip concept because I always talk about, oh, buy the dip, buy the dip. Buying the dip wrong can be just as bad as panic selling, if not worse.
All right. Let's get ready to take some notes. I actually do. I'm going to take notes. I'm going to email Tom after this. I'm like, Tom, I took notes. I'm really going to do that. All right. All right. I got my notepad ready. Let's do this. I'm literally going to take notes, so you should do so too.
Worse. In September 2008, we had Lehman Brothers. A lot of you don't know what that is, but for the younger generation, Lehman Brothers was the Rizzle Dizzle.
Sorry. That was funny to me.
They were the kings of Wall Street. They basically went bankrupt. And a lot of people assumed this was the bottom, started buying in like crazy. And then the S&P 500 continued to fall all the way down to March 2009, 6 months later. And then the same people who were buying the dip like crazy capitulated, sold right at the...
He did not. He stole it. Oh my gosh. Tom, you thieving dirty dog. This is my slide. This is my slide. This is my slide. That dirty dog, Tom, stole my slide. How dare he? Which, of course, I stole from somebody else. But I can't believe he's going to reference the market cycle.
The bottom. And then the market spiked up and they said, hey, we're out for good. We don't understand what we're doing. So staying disciplined is super important, whether it's 2008 or 2025, it doesn't matter. Now, a lot of people in the comment will be cynics and they'll tell you, well, this is just DCA bullshit. We don't have time for this. Who has 10 years? Who has 15 years? Who have enough money to continue DCA? Look, in my academy, I explain all of this. How anyone, no matter what your time horizon is, no matter how much income you got, no matter what is your financial situation, anyone can stay disciplined. Anyone can continue to DCA. All of these things you can learn in the academy, or you can stay on the sidelines and complain like these guys. But guess what? The comments complainers are not making money in this market. We, over the past 3 years, have made a lot of money. My community over the past years have made generational wealth because we actually implement this. We look at this day-to-day, week-to-week price fluctuations as nothing but, just noise. Who cares? Who cares? Markets move like crazy on the slightest rumor. You've seen what happened yesterday. This is unpredictable. Nobody can time this. And people look for these green days to continue forever. They cannot, process red days. That's unrealistic. That's not how the market works. Obviously, what we've seen in the past 5 years mostly was green because we've printed a shit ton of money. That thing is over. So you got to get used to the normal market again. But it doesn't matter because over a multi-year horizon, every big drop is always followed by a massive.
Well, I'll tell you what. You steal my slide, I steal your slide, my friend. Let me get my screen capture thing out here. Oh, that was today's thumbnail. I'm gonna screen cap this right. Yeah. I done did tell you what. You done did stole my slides. I'm gonna steal your slides right on back. Tell you what. There we go. That's right.
Massive bull market. A drop is usually 10 months. A bull market is usually 5 years. That stat is based on the 100 years of stock market. That's never going to change. I want you to pay attention and understand that what happened.
Dude, I know. That was the joke. That was the joke.
For the past few weeks is just a little example of the overall investing journey you're going to have for the next 10, 15, 20 years. Don't ever panic sell during a major drawdown. It's never a good idea, no matter how.
Okay, I can agree with this. I can agree. Surprisingly enough, hang on. I gotta do a tiny bit of PowerPointing. There we go. I can agree with this. Don't sell on this side of the curve, right? If you're on this side of the curve, it's probably too late. It's probably far too late. Right. I mean, like when you're reaching the panic, capitulation, anger phase, and you're like, oh, well, I guess I'll just hold this for 2 years until it comes back because I don't want to I don't want to have a losing trade, right? I can agree with that. So if you're selling on the deep, dark, awful side of the slope of hope, that's not where you want to be selling. You want to be selling up here at the euphoria complacency stage. Now, let's talk about how we identify those points. And we're going to use Tesla as an example. Tom is ultra bullish on Tesla. And I have no opinion on Tesla. My opinion on Tesla is that Tesla looks like this. I mean, Tesla looks like this. So, to this point, you can see here, this is stage 1 at the left-hand side. Right, I'll highlight this for you. This is stage 1 over here, where it's consolidating, figuring itself out. Stage 2 is this big bull run that everybody wants to be in. Right, stage 2 is the green box right here. Stage 3 is the topping at the topping pattern, right, and that's where the moving averages start crossing back. And stage 4 is the downward side. This is the side nobody wants to be on, but so many stocks are these days. And a lot of people don't want to admit they're in stage 4. Don't want to admit they're in stage 4. But to that point, let's go up here and we can do an exercise I like to call red light, green light. So green light, meaning when the 10 EMA is over the 20 EMA and price is over the 50 EMA, and then you have a close back over the 10. Okay, that would be a green light. Let me zoom in just a bit for you. So you got this pop over, came back under. Now it closed under the 10 and another time again right there. So if you want to get really pedantic about it, you could say this was a green light and this was a red light. Okay. And then the next day it was a green light. So let's just do a bit of math right here. You would have lost 6% on that move. You know what? Sometimes that happens. You make a buck or lose a buck. But if you do not consider that the previous trade has any bearing on your current trade and still follow the red light, green light theory right here, you'd have got to run up this entire way that might have closed under, maybe not, but we'll say it's not just for my illustration here. You could have got out right here, red light on this side, red light over here. So if we measure this, right, that's a 69% move. So you gave up 6.8% on this side to make 69% on this side, following the exact same to the T principles of getting in when the price crosses over the 10, getting out when price crosses under the 10. Now, when prices are coming down, they must mathematically go down through the 10 EMA. And this is why I can tell you this with absolute certainty, because mathematically, they must come through the 10 EMA before they go down. They must. So if you are selling, panic selling on this side over here, you and I both know you probably missed the exit signal. You probably missed the exit signal for sure. Because to me, when I get a close under the 10 EMA, let's mark every time it goes back over and then under again. So that was the red light right there. That's a red light. This is a red light. Let's just mark all the red lights is what I'm trying to say here. This is a red light. And that's it. That's it. That is it. Goodbye, good night. Right? You had ample warnings to get out. You had ample exit signals to get out. You had ample opportunities to get out. And those people who say you can't time the market, I'm sorry, I have to disagree with you. You're not going to catch the top or the bottom, but you certainly can catch the middle 80%. The top 10% and the bottom 10% are the hardest and most expensive parts of any trend because everybody wants to be the one who catches the top or catches the bottom. But you don't have to do that. You can just roll the 80% in between and you can make all kinds of bank. And you can be out before this kind of hot baloney shows up on your chart. So yeah, I agree with him. If you're down here on this side, it's over. Just game over. Just quit. Not really. But point is that if you have money in the markets, first off, all stocks are bad. All stocks are bad because they have market risk. Sometimes they act right. Sometimes they act right, like over here. Sometimes they act right. But all stocks are bad because they all have risk to your portfolio. And if you don't know where you're going to get out, I would suggest getting out now and then figuring out where that point is that you will get out in the future, right? And all jokes aside, if you are in a downtrend like this and you still don't know what to do, just take a look at AMD. If you're in a downtrend like this and you don't know what to do, just take a look at AMD, right? Some people said it couldn't possibly go lower at 162 and then at 140 and then again at 120 and then again at 100 and then again at 90. And what's it done the whole way? It's gotten lower and lower and lower. So always, always, always trade risk first. That's the most important thing.
How low the bottom is, no matter how much more it drops, panic selling is never a good idea. Never. Number two, you have to manage risk before the events happen, not during. I have 17,000 members in my academy. I have almost 500 subscribers, 500,000 subscribers on my YouTube channel. Most people, statistically, they don't sign up for the academy, and that's okay. They love the videos, they enjoy the videos, but then you know when they sign up? They sign up when the market starts doing this. Then all of a sudden, during the crisis, they sign up and looking for quick solutions. You got to do all this before this happens. You have to have a plan.
There you go. I hope he's about to say, you've got to have a plan.
They sign up and looking for quick solutions. You got to do all this before this happens. You have to have a plan and put it in motion before the crisis hits you. So
And that's why Tom and I, whenever he doesn't ghost me anymore, are going to make great content, because we have very, very fundamentally similar beliefs, just different execution. But the fact that he's just saying right here, just have your plan to start with, that's a huge thing. That will separate the best from the rest.
Just because right now we have a little bit of a breather, it's not a time to forget this. It's time to join up, patreon.com/Nash, and build a strategy for the next year, 2 years, 3 years. So you don't predict, you prepare. So you have a plan in motion before the bad event starts happening. Number 3, you have to consider dip buying as an essential way of life. A lot of people think that dip buying is a decision you make once the stocks drop. Oh my God, is this a good time to buy the dip? Is this not a good time to buy the dip? That's an irrelevant question. If you want to own A stock or a B stock or a C stock or this index, it doesn't matter. There's no good or bad time to buy. You buy at all times. Your dollar cost average, high rain, high water, high tide, doesn't matter. And if it drops, you continue to do the same thing, just with bigger amounts of investing. That's the whole purpose.
Ooh, that I don't like. That I vehemently disagree with, right? I vehemently disagree with that. When it's going down, buying more as it's going down. Bro, the problem here is you just don't know how low it's going to go. You just do not know how low it's going to go. Like I say, buy stocks while they're crashing up, not while they're crashing down. Use the trend template. And let that help you. You can dollar cost average all the way up on this side, right? Why not? But when it's on this side, why are you doing it? And you might be saying, well, so I can get a better price, Chris. The problem with that theory is, I'm trying to think of an example. The problem with that theory is that you're going to get the same average price if you buy it on the way down versus buying it on the way up. I know this doesn't sound possible, but if you're buying 100 shares here, 100 shares here, and 100 shares here, then it starts going back up and you buy at the same exact spots, your average price is still the exact same price. I know it's hard to believe. I know that doesn't compute to most people. I know it doesn't. But wouldn't you rather be to profitability that much faster? Wouldn't you rather be into something where you're like, oh man, thank goodness I got the wind at my back. Everything's working easy for me. I'm going downhill, right? I'm riding my bicycle downhill and I got the wind at my back. It just makes life easy. Versus, going uphill with the wind in your face, trying to do the Tour de France, and you're getting absolutely monkey hammered because you just don't know what you're doing, and you're buying more and more stock as the price is going more and more down, right? And thankfully, Tom has not talked about the fundamentals, because that doesn't matter at all. Like, we had a conversation with JC this morning. JC is one of our live stream viewers, but had a chance to speak with him this morning, he, Mahesh, and I, and he had some incredible ideas that I really would like to implement. And it really just lights up the fact that you've got to speak in a way where people understand. And so that's why I try and boil these things down to the ease that I do, right? 3 moving averages, red light, green light, trying to make sure that it's an easy way to understand when to get into the market versus when to not get into the market. So let's continue on with Tom here.
Purpose of what we're doing here, buying the dip.
Oh, sorry. Yes, I have emailed Felix multiple times now, have yet to hear any response. So if you guys could do me a favor, in fact, I'll ask you this. For those of you who watch both Felix and myself, when you're on his live streams, would you do me a favor and start commenting in his live streams, just like Senior Wahoo did right here, that you should do a collab with Chris Ewell? That would be awesome. In fact, I know Anas Q was in his live stream one time talking about monkey hammers. That was pretty cool. So if you are watching his live streams, do me a favor. Say, Chris has been emailing you, but you haven't emailed him back. And we want to do some collabs for sure.
Is not something you do out of the blue. It's not sporadic. It's very methodical. You always buy, and you buy a little bit more when it drops. DCA is a way of investing. It's a way of life. It's not a decision that you make here and there. Now, a lot of people ask me, well, Tom, how do I always have money to DCA? I'm not rich. You ain't got to be rich to DCA at all times. I explained this many times in my academy. There is a system in which no matter how much you're making per year, 50,000 or 500,000, you always have enough capital to deploy at all times. Now, another thing I want to pay attention to is that long-term outlook here is critical. A lot of people look at the short-term price action and they think this is reality. If you zoom out and you look at the S&P 500 of the past 15 years, and you start thinking,
don't mind me, just stealing stuff. Sticking this in my PowerPoint deck. And back to the show.
About all the crazy stuff that happened over the past 15 years in the world, in America, in the stock market. A lot of reasons to sell, and yet the S&P 500 did 700% in 15 years. That's one of the best performing asset classes you can think of. Another thing here is you got to be always prepped for a major big time crisis ahead. Nobody knows when that crisis happens. We're talking about a 2000, 2008 level of a crash. It can always happen. You have to be prepared for it. You can't just say kumbaya and just relax and hope it doesn't happen. You have to be set up for that. And there's ways to prepare. Again, teach that in the academy. And of course, psychological resilience. A lot of people kind of miss this point. If you look at the top 10 tennis players in the world, the biggest differentiator is this, not their skill set. They're all elite tennis players. What they have here is the big differentiator. The same thing with Michael Jordan, what he had here, his ability to rise up. Joe Montana, I can name it. Psychology, resilience, emotional control, all these things matter probably more than anything else. And of course, here's the final 5 things. Get out of margin. Margin is bad. Margin is not good. There's no way you ever can make an argument that margin is good to use for retail investors. Margin is the death of portfolios. Never, ever get into margin. Number 2, understand macro, but don't obsess over it. Understand it, get a good idea of it, don't obsess. That's going to cause you to make irrational decisions, emotional decisions. Of course, keeping cash on the sideline is one of the most important elements of DCA. We teach this in the academy. I'm going to give you away the formula real quick here. Basically, what we do, and we teach the system, is we deploy only 50% of our free cash flow at the end of the month. And that way, when we have a dip, we always have sideline money that we've been accumulating when the market was high, which we can deploy when the market goes a little bit with turbulent time. And of course, diversify your portfolio. A lot of people DM me and say, oh, I'm 80% Palantir, I'm 80% Tesla. You have to have a diversified portfolio. You have to.
To that point, diversification is important. Mainly because you don't want to be too concentrated in any particular asset, which is why you need to have your position sizes ahead of time.
Be smart. You have to be responsible. You can't go all in on one stock, no matter how much you love it. You have to invest in quality over everything else. If you're buying stocks, you're buying a piece of the company. If you invest in quality companies over the course of the next 15 years, there's no way the stock market is not going to reward you. Time in the stock market is the best friend of a great company. Never forget it. And speaking of time, probably the most important principle of them all, timing the market is a hell of a lot better than time in the market. If you've missed the top 10 days over the past...
Oh, yes. Thank you. This is one of those slides that everybody thinks that they're such a genius for showing. And, you know, yesterday we had that giant move, 10% up in the SPY during a downtrend right here. Right. And they're going to say, oh, you had to be in on the top 10 day. Yes, of course. Of course. It makes total mathematical sense. If you are in the top 10 days, you're going to have outstanding returns. The problem with that is A, you don't know when those 10 days are. So their theory is always be in because you never know when those 10 days are. But who gives a flying flip that you had a 10% up move when the market's already down 20%? Does that help you net? No, you're still down 10%. And of course, if you take all the best days and you're like, you're a genius, you have to be in on all the best days, why not do the same for all the worst days? If we're only going to focus on the positives here, if we're only going to focus on the greedy aspect of it, why don't we talk about the fearful side of it? Why don't we talk about the risk associated, right? What about the 10 worst days? I would bet you the 10 worst days would look a lot worse than the 10 best days right here. But people love throwing this chart around. This chart is so brain rot. This chart is skibba-dee. This chart is so Ohio with a giat. It is so bad.
20 years in the stock market, a day like yesterday, which was out of the blue, your return will be slashed by 50% in 20 years. Because
this is so freaking dumb. I hate this so much. Invested in all days, missing the 10 best days. Well, no crap. If you're in for just the 10 best days, you're going to have amazing returns versus everything else.
10 meager days. Yesterday was prime example. Stay invested.
Yes, yesterday was a prime example of why that's a stupid chart. Because you look at it and you're still down. You're still hella down. You don't have these giant 10% up moves unless somebody tweets from their toilet during a bull market. It just doesn't happen. It just does not happen. Sorry, it's just a fact. So let's take a look at the market real quick. And I know a lot of you are sitting over there thinking, hey, when is he ever going to give us that 3.0 secret code of the day? Don't worry, it's coming up. My name is Christopher Uhl. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. Now, as promised, I'm going to give you the secret code of the day. If you go over to outlierdeal.com, we have something special for you over there. We are excited to announce the Outlier 3.0, which is due to come out next week. Mahesh is losing so much sleep because he set a date. He set a date for when he wants to go out, and yeah, he's definitely losing sleep. But top prize in the Outlier 3.0 is $1,000 and a full year of Outlier. And listen, I had somebody leave a comment earlier. They're like, "But I just bought a year of Outlier." Dude, don't stress on it. Next year's on us. Next year's on us. No stress. So if you already have an Outlier plan and you win, you'll get another year. How's that sound? How does that sound? You're still going to get the year that you paid for, plus another year added to the back of it. Now, first runner-up will get $200 worth of Outlier merch, plus my 5 favorite trading books, which is Trend Following, New Trader, Rich Trader, How I Made $2 Million in the Stock Market, The Complete Turtle Trader, and Trading in the Zone. And second runner-up will get $150 worth of merch, plus all 5 of those books, the 5-book bundle. Now, the way you enter to win all this is you just go to outlierdeal.com. Outlierdeal.com, very easy to remember. And there's a handful of things that we'd like you to do, like go subscribe to the YouTube channel, repost a couple things for us, tag a friend, and leave a review. It's really not all that much to do, but we have over 4,000 entries, if you can believe that. It's crazy. And we got the leaderboard over here. Deep Thought somehow has hacked the code and has 177 entries. Nikolai has 157 entries. Art has 192. Ween has 77. Listen, Deep Thought, whatever you're doing to hack this, I know it starts with number 42. You need to cut it out. You need to cut it out. Okay. Let everybody else have a chance. So be sure you do that over at outlierdeal.com. And today's secret code for April 10th, 2010, today's secret code is Batman. I get to choose these codes. I'll tell you what they are. So I'm going to do this. What did we learn from Tom's video? What did we learn from Tom's video? All right, let's break this down. I actually took notes over here, and he didn't quite talk about specifically when to buy the dip. I wish he had. I would have really liked to know that. But what did we learn from Tom's video? Deep Thought says, "I will never stop." He hacked it. Alan asks, "Can I upgrade my monthly plan to yearly and get the discount?" Absolutely, dude. In fact, inside of your portal, I don't have it because I have a different plan than you. You should be able to see. Oh, I clicked the wrong button. Sorry. Let's go to any stock. You should be able to see a button up here that says no. Hang on. That's you can save 64% and get the annual pass for just 82 cents a day. Or tripping over myself here. Or you can upgrade and save 64% with just one click. There you go. I got my pitch in. It should look something like this. Jonathan says, "Buy the dip." That's what he learned. Kevin says, "And the next days following were bad. What FOMO are they selling?" Yeah. Are these slides on the Discord? Absolutely. Inside the VIP investors toolkit. Georgia learned that Trump sends tweets. Jonathan says, "Keep your cash on the sidelines to buy more dips," and that's honestly not too bad of a result there, right? And that's what I'm doing. I know that it could sound like I preach against that, but I have all my cash on. I have plenty of dollars in the bank, waiting to do something, waiting to get busy. As my dad would say, it's burning a hole in my pocket. Now, am I going to do anything right now? No. Am I going to do something after the market finds its bottom and starts going back up? Yeah, for sure. I might go short if my signals line up. And I definitely will go long if my signals line up. But in the meantime, I'm holding cash, waiting for that. Dennis learned that Tom's ignoring me. Georgia learned that Tom steals slides. Andy says, "Buy the dip." Ahmed says, "Can you teach us one-on-one?" I don't do any one-on-ones. But what I do is this. And in fact, you can ask all the questions you want, and you don't have to spend a single red cent on Outlier. You don't have to send me any super chats, anything like that. The way that you can pay me back, and I'm being very serious, the way that you can pay me back is to tell more people about this channel. Tell more people about this channel. Tell everyone you know so that they can come and they can learn. Like Tom was just saying, he's got nearly 500,000 subscribers. My itty bitty baby channel needs more subscribers, right? My itty bitty baby channel, the Christopher Rule channel, which clearly gives me different results to what I actually want. The Christopher Ewell channel actually has about 24,000 subscribers. Now, I did see something up in the chat earlier I wanted to talk about. Hang on. I'm scrolling up through the chat looking for it here real quick. Somebody had asked if I would get more traders on and interview them. Where's that at? Sorry, I'm going through the chat here. I really want to point this out. Heck, I can't see that right now. But yeah, someone, and I forget who said it, said, hey, why don't you get other traders on to talk about trading? And here's the deal. I have over 2,000 videos. You're more than welcome to go through and learn so much in the past. And that's that person who mentioned it earlier, and I forget, I can't give you any credit. They said, why don't you have traders like Brian Shannon on to talk about his VWAP? And I actually have done that already. I did that 4 years ago. So yeah, if you ever want to go see Brian Shannon talk about VWAP,
if you can build
look at that,
a tool where I can point and click on any spot on the chart and it shows.
Look at itty bitty baby Chris, who has a terrible camera, terrible lighting. It's awful. Yeah. Anyway, way back when. Yeah, Nico, thank you. I've done exactly that. And like I said, I have 2,000 videos on here. So I'm pretty sure that you're going to find a video that was worth your time. Definitely worth your time. Let's see. Ahmed says, thank you. You'll get more to do some advertising. You'll get more than him. Dude, I would love to have more than him, but I don't need that. What I do need is to make sure you go tell somebody, how did you get your forehead so shiny? First off, Huey, I'm banning you for that comment. Where's the ban button? No, I'm just joking. Okay, let's go back over to the slide deck real quick. Slides. You already went to outlierdeal.com. You already put in the secret code Batman. We already talked about what we learned. So it's your choice, right? Be lame or do what we talk about in these videos. So let's do today's member highlight real quick. So in the member highlight, I like to jump in the Discord and answer a couple of questions and also showcase a few of our members. First, questions from you. Okay, first question. Paul had asked, how do you explain volume calculated on the charts? I thought it was the number of shares traded. And this person saying number of contracts. I have no idea where he's getting this number of contracts from. As far as I know, it's always been the number of shares traded, but I could be completely wrong. This is news to me. BC1116 asked about the tick index. So I did a quick Google. The tick index compares the number of stocks that are rising to the number of stocks that are falling. So it measures the upticks or downticks. So that's not something I've ever looked at, but you're more than welcome to look at that if that fits your trading strategy. And I think that that's important. Figure out what works for you. A couple of YouTube comments came through and I wanted to answer those. I'm very new to this, so any help answering my question on this video would be appreciated. What I understand is that if stocks go down and keep going down, is it to sell and not hold? Okay. So what I'm assuming is, let's use Tesla, for example. They're saying to sell and not hold. That is the way that I would do things. Yes. So let's go back to this question here. Then buy the same stock that we sold again when it starts going back up. Yes, exactly. Right. If the stock is going down, you can get out. So you can capture these gains up. Right. Let's just do some round numbers here. Let's say you went from here to here. You made $178 and you got out. And then Tesla went down. And then it does it again, right? Maybe it goes up another $178. The cool thing about this is that, and I'm just using, this is not a green light. I'm just saying, let's say you get back in right here. 178 on this side, another 178 on that side. Yeah. Wouldn't you want to do that? Right? That's profits in your portfolio. If a stock is currently down from its peak, but someone is still in profit because they bought at a lower price, even though the market's down, they still have to pay taxes on the gains. Well, you pay taxes at the end of the year. You don't pay taxes like immediately. It's not like a sales tax. And so all of those taxes will be added together. And in fact, it'll come off your losses too. If you have losses, it'll do the same. It'll work against that. How does that work if you sell, pay taxes, and then buy again at a lower price? Okay, exactly. So unless you're doing on like December 31st and again on January 1st, it's not going to be an issue for you. It's going to be basically you're incurring a tax liability as you have gains, because you have gains, you have more money in your account. So the government feels like that you owe them for that. And then you do it again, right? And yeah, I'm not understanding why that's a question here. Should people only sell when the stock drops below their own purchase price to avoid taxes? Absolutely not. If you did that, if you sold when the stock drops below your purchase price to avoid taxes, then what was the point of even making the investment in the first place? What was the point of even doing that? You are much better off putting it in a savings account where it's not at risk, right? So the question would be, would you only sell if it goes below this point? Let's say you got in here, only sell when it goes below this point so you don't have to pay taxes? No, I couldn't imagine doing that. No, for sure not. Where's the best place to keep track of it? Thank you so much. So your broker is going to keep track of all your P&L for the year, and it's going to be one lump sum. It's not like you're going to say, okay, you owe $7 on Tesla and $1,000 on NVIDIA or whatever. It's going to be one lump sum. You're going to give this to your accountant or TurboTax or whatever, and you're going to put it in. And it's going to say, okay, you owe X dollars for all your stock trades for the year. That's what you need to know. And you can just take that out of your trading account, right? It's not like you got to go scramble for it. If you're up on the year, then in theory, you should be able to just pull that out of your trading account and pay your taxes. So it's a good question, I guess. Another question here. The only thing you're not taking into account is taxes, short-term versus long-term. If someone was up quick, that could cost a ton of extra money versus waiting it out a bit. I couldn't disagree more. Wouldn't you rather pay taxes as the price is going up, right? And here's the deal. All stocks are bad. You've heard me say this once or twice before. All stocks are bad. And if you get in and you get out and you've captured $198 in this case, and then it goes down, I would much rather have to pay tax on the $198 that I just made per share versus not selling and watching it go down just because I don't want to pay the taxes. It's equivalent to saying, I want a promotion, but when you're offered the promotion, turning it down because you're saying, you know what, I would love to make more money, but then that means I'd have to pay more taxes. Paying taxes is a consequence of being profitable. So unless you're okay with being profitable, you need to start getting okay with paying taxes. And one last question here. Another tax question. What about paying taxes whenever you sell? And that's a big if. Okay. And then and that's a big if, you catch the right side of the curve, is it going to be beneficial to your portfolio? I can't imagine how it wouldn't be beneficial. We just talked about that. If a stock is currently down from its peak, but someone is still in profit because they bought at a lower price, even though the market's down, they still have to pay tax on the gain. When they sell, yes. How does that work if you sell, pay tax, and buy again at a lower price? This must have been the same person. Yeah, it was. So point being is that, dude, I would love to pay some taxes. That means I'm making money. And I don't know about you, but I care way more about making money than I do about paying taxes. Taxes are a natural consequence for making money, which is a great thing to have. That is a great thing to have. So, of course, be sure to share your stories in the Discord. And the first row of Outlier, you should tell everyone about Outlier. And you hit the like button. Now, what is Outlier and how does it work? Old Uncle Warren used to say, be fearful when others are greedy and greedy when others are fearful. Outlier shows you if investors are acting irrationally fearful or greedy and by how much, allowing you to get in before the Outlier move happens. Now, you can save time, make money, and start with less risk over at outlier.com. You can get it for just 82 cents a day. I already mentioned that earlier. And my style of trading is called the golden ticket trading strategy. And it starts with what the market's telling us. What is the market telling us? The market's telling us that prices are going down. Prices are going down. And even though we had that giant move yesterday, prices are still trending down. Next, market breadth. How many buy or sell signals do we have today? Let's go take a look. We got 36 new buy signals and only 5 new sell signals today. So a little bit of a reversal today, In fact, Datadog had a buy signal. DigitalOcean had a buy signal. Duolingo, I didn't know that was a tradable stock, has a buy signal. And Robinhood has a buy signal. And then if we look at the market breadth, if we look at the market breadth, we can see here that while it is still in a bearish posture, we might be having more buy signals come through, which means we might just be near a bottom down here. We just might be near a bottom. So the master key has me locked out today because of that, and that's okay. I don't need to trade every day, and neither do you. You need to make sure you keep your risk in check, and that's the most important thing with trading. So be sure that you come back tomorrow, where outliers like us will save time, make money, and start winning with less risk together as a team. YouTube is going to pop up a couple recommended videos. I recommend you watch them, and I recommend you have a fantastic afternoon. See you tomorrow morning.